Sinjuri nsellmilkom nilqakom għal programm ieħor ta' Flusek. Illum ser nkunu qed nitkellmu ma' żewġ rappreżentanti ta' Fund Managers Internazzjonali li qegħdin f'Malta l-konferenza dwar is-swieq finanzjarji. Iż-żewġ mistiedna tagħna llum huma Celia Soares u Dimitrios Batsis. Ngħaddu għall-ewwel intervista ma' Celia Soares. Celia, welcome to Flusek.
Thank you.
I was just informing our viewers that you are a client portfolio manager in the fixed income markets mostly, and that you'll be sharing your thoughts with us today.
My pleasure.
So undoubtedly this year has been a challenging year, both for equity and the bond market. As I said, your area of focus is the bond market. How would you describe the first 5 months of this year?
Thanks for the invite, and I think the first 5 months of this year can really be described as a roller coaster. I mean, we've entered the year thinking it was going to be sort of a positive year for growth. All the outlooks were very positive for the asset class, and then it started derailing with the threat of tariffs. And then we had the big announcement on the 2nd of April, and obviously some correction of the markets after that. So it's been a bit uncertain. It's been quite different to what we expected at the end of 2024. But obviously risks comes with opportunities, so that's something that we're looking throughout this year.
And with respect to investment grade bonds and the high yield bonds, did they react differently to the volatility?
Not initially. So you did have a correction on both sides of the rating spectrum. Both had a bit of a correction in terms of spread widening. What we did see after was a bit of, immediately when you saw the correction, then investors took advantage of that correction to come back into the asset class, particularly in high yields. We saw initially some inflows into the high yield asset class and then into IG as well. What we are seeing, however, is a divergence between regions. So before it was more of a sort of global view for developed markets, and now investors really want to make a call or want active managers to make a call, for like we are, in terms of relative value between the US and between Europe. So that's definitely a trend that it's developing in the bond markets and high yield and investment grade.
With regards to the uncertainties around us, with regards to the US tariffs mostly, how are fund managers in the bond market positioning themselves?
So initially there was already sort of headwinds building at the beginning of the year. So some investors were already a bit more conservative. After the big announcements in terms of tariffs, some of the investors became a bit more conservative. But they are very aware they don't want to be out market. So they want to be in the market to be able to participate on the rebound. And that's exactly what happened after the announcement of the pause on the tariffs. So I think overall investors are keen to remain invested out of cash because yields are attractive. And definitely more on the conservative side, because there's a lot of expectations that we're going to have some uncertainty, volatility when we see all these negotiations back and forward. So being invested, being in the markets, being ready for the rebound, but a bit more conservative as well.
We hear a lot about central banks' decisions with regards to interest rates. Will they lower rates? Will they stay put? Do you anticipate that there will be a divergence between the different central banks, between the Federal Reserve and other central European banks?
Historically, there wasn't a big divergence, so everybody followed the Fed. The Fed was usually the first one to cut, and then you would see the other central banks following. This time around, slightly different. So we saw the European Central Bank cutting first. 2 reasons. One of them is obviously the divergence of the inflation paths of these different countries. Now we have concern that, for example, in Europe, we might have an undershoot of inflation. In the UK, inflation is still quite high. So there's the concern that the Central Bank of England won't be able to cut rates as faster as others. And obviously then we have the US and concerns of tariffs that might create some more inflation, upwards inflation in the country. Also to remember that the Fed has a dual mandate, which is different from the Central Bank of England and the European Central Bank, where they want to consider the inflation and maximum employment, where in the UK and Europe we just want to remain, keep inflation under control. But it's really, so employment is more or less stable in both sides of the Atlantic. It's really the inflation trajectory that it's quite different now. So the expectations is that we are going to see that divergence in terms of the speed and where to the cut rates on both sides of the Atlantic.
And how are the changes in central banks' decisions in the months ahead likely to impact the bond market?
So it impacts very directly the companies because it creates different financial conditions. So for example, a high yield company coming to the market will be impacted by the refinancing rates that it will be able to get, and that's obviously is correlated to the interest rates. So initially cutting rates, it's good for those companies, easier financial conditions. But then there's the other side of the coin, which is if they cut rates too quickly and seem too aggressive, then it creates a little bit of fear in the markets that actually growth is actually not as stable and positive as maybe the market was expecting. So it's a bit of a balanced act that the central banks have to put on, and that's something definitely we're monitoring.
In the past few months, we have seen investors which were reducing their equity positions from the exposure to the US, moving into mostly European equities. Do you see this also happening with bond investors?
No, so it's very true that we are seeing that trend on the equity side. Fixed income and bond markets are slightly different to equities, and equities is very much focused on the growth trajectory and this prospects of growth. Fixed income, we're more focused on can the companies actually pay their debt. So it's necessarily to have a supportive macro backdrop, macroeconomic backdrop. But it's not to say that it's not directly correlated with growth, but we have to understand that it's a different sort of experience for debt issuers. So to answer the question, we don't necessarily think that trend is going to be the same for fixed income markets, just because it's not really driven by this growth trajectory that we see on equities. Having said that, we do have investors that want to have that relative value call being made, whether if it's in a global portfolio or regional allocations. But disinvesting from a whole region, I don't think that's necessarily a trend that we were going to see on the fixed income markets.
Okay. In such an unstable and geopolitical situation, what should bond investors expect in the months ahead?
Well, I think the sort of consensus is the uncertainty is the only certainty that we have at the moment, and it's really true. Let's not forget we're going to have more negotiations between Trump and European Union. So we're going to see still a little bit of market volatility that it's been driven by headlines. But having said that, the beginning of the year, the worst expectation is that we have tariffs. At the moment, the best expectations is that we have 10% tariffs, and still investors are still positive. So there's a certain resilience in the market, and investors are still very positive. But I think the consensus is the expectations that we're going to have some volatility, particularly now in the next couple of months, until things stabilize a little bit more.
Thank you very much, Celia,
My
for
pleasure.
being with us. And
thank you.
Thank you for your time. Bekka namlu għaffata ftit minuti għal-riklami f'għaw magħna.